Good afternoon, everyone, both to those of you joining us here in person and to everyone joining us online. Welcome to this IMF press conference on the conclusion of the 2024 United States Article IV consultation. I'm Julie Kozak, Director of the Communications Department here at the IMF. By now, you should have the IMF staff's concluding statement, which has also been posted on imf.org. Let me start with introducing our speakers. Kristalina Georgieva, Managing Director of the IMF, Rodrigo Valdez, Director of the Western Hemisphere Department, and Nigel Chalk, Deputy Director of the Western Hemisphere Department and Mission Chief for the United States. The Managing Director will start by delivering some opening remarks, and then we will take your questions in person on WebEx and via the Press Center. Managing Director, over to you.
Thank you very much, Julie. Let me start by thanking the U.S. authorities, and especially Chair Power and Secretary Yellen, for the engagement we have had. Very constructive discussion that allowed us to finalize our concluding statement. Today, I would like to make 4 key points. First, on the performance of the U.S. economy. It has been remarkably strong. Activity and employment have exceeded expectations, and the disinflation process has proven less costly than most feared. The U.S. is the only G20 economy whose GDP level now exceeds the pre-pandemic level. This is good for the US, and it is good for the global economy. We expect growth to be a healthy 2% this year on a 4-quarter-over-4-quarter basis and sustain a similar pace over the medium term. Inflation has declined in response to the Federal Reserve's actions, and we see inflation on a path towards the 2% target. The Fed's efforts were aided by important gains in labor supply, including of women, and strong productivity gains. This is what makes the US economy so remarkable vis-a-vis its peers. We expect core PCE inflation to end this year around 2.5% and be back to target by mid-2025. This being said, we do recognize there are important upside risks to this path. Given those risks, we agree that the Fed should keep policy rates at current level until at least late 2024. The economy is doing well, which provides the Fed with significant room to maneuver. The policy rate should be lowered only after there is a clear evidence that inflation is sustainably returning to the 2% target. I want to recognize that a lesson we learned from the last years is we are at the time of more uncertainty. This uncertainty also lies ahead. We are confident, however, that the Fed will move through that uncertainty with the same prudence it has demonstrated over the last year. It would be guided by incoming data and will communicate carefully how it assesses progress in reducing inflation and the implications for the expected path of the policy rate. My third point is on the significant exogenous shocks over the last years. They have pushed further already high debt and deficit levels. Now, when there is a strong economy, it is the time to arrest and reverse this trend. The US has put in place significant fiscal legislation in 21-22. This legislation will have a lasting positive impact in reshaping the US economy. It needs to be complemented, however, with actions to put public debt to GDP on a decisive downward path through a broad range of policies that include raising tax revenues, addressing structural imbalances in the entitlement programs, and looking for savings in non-entitlement spending. And finally, I want to recognize that there are reasons for the US to pursue some measures in response to concerns about unfair practices, national security concerns, supply chain resilience that have led to tariffs and some measures to protect national content that, in our view, may be better addressed through more dialogue with trading partners. We think it would be less costly for the US and the global economy, instead of relying on tariffs that are likely to lead to retaliation from trading partners, to go for more dialogue to promote fair trade and to reinvigorate the rules-based international trading system that has served the US quite well. So these are the 4 points we have for you today. And with those, Julie, back to you, and I guess from you to our guests here and online.
That's right. Thank you, Kristalina. So we're ready for the Q&A session. For those of you connecting virtually, please turn on both your camera and microphone when speaking. I will also ask that you please introduce yourself and your outlet. Please stick to one question so we can take as many questions as possible in the short time that we have. And also, let me remind you that this is a press conference on the United States. If you have questions about other countries, we'd be happy to respond via our media and social outreach team. All right, so let's start in the room. Daniel, let's start with you. Go ahead.
Thank you for doing this. I have a question for you, Managing Director. Daniel Davis, AFP. I was just wondering, you mentioned that you see inflation falling to the Fed's target, 2% target by mid-2025. The Fed's own median dot from its June forecast is for a 2026 return to target. I just sort of wonder, why are you feeling more optimistic about the US inflation path than the Fed? Thank you.
We actually had this discussion with Chair Powell that our expectation for inflation to come down to target is a bit more optimistic than the Fed's assessment. And it comes from what we have seen as trajectory of inflation since its peak. And it is, if you take that, if you take this trajectory, it gives us some confidence that it would lead to a tangible reduction in inflation and ultimately inflation going down to target by mid-2025. We also see that a very important factor for the strength of consumer demand, which has been reliance on the boost in savings from the pandemic time, may be coming to an end, meaning that the strength that has defined this pressure on goods, but especially services, it may be somewhat less evident. And let me make sure that my colleagues.
Yes, I think that's true, and I think The difference is really on where the distribution of risks are. I think we both see risks to the upside, the Fed and our forecasts. I think we have built in more into the baseline the fact the labour market's cooling. As the managing director said, consumption's slowing. We're seeing signs that shelter of inflation's finally coming down in a sort of more consistent way. And so I think when we build that all into our forecast, we get inflation coming down a little bit faster than the Fed. But it's 0.2 or 0.3 on the inflation.
It is not a significant difference. I also want to recognize that we do agree with the Fed that they need to be careful, they need to be cautious. It is just a matter of how we see the projected trend of inflation, and we are a bit more optimistic. May I say, last year we were a bit more optimistic. Last year we have proven to be right. May we be proven to be right next year, 2025 as well.
All right, I'm going to go online. I see one hand up, and I think that is David Lynch. So David, why don't you please go ahead?
Lynch from the Washington Post. Good afternoon, Managing Director. I just wanted to ask you, in connection with the remedies that the statement lays out for the U.S. deficit and debt position, which include tax increases, including on people making less than $400,000 a year, which is something President Biden has explicitly ruled out, and painful entitlement reforms. I'm wondering whether you've seen from your conversations with U.S. officials or any other source any indication at all that the U.S. government is prepared to make those choices, and if not, what are the consequences for the global economy?
We have had a very robust discussion with, especially with Treasury, on this topic, and it is consistent with our views on their side that there are steps that can be taken to reduce the deficit. Mind you, we are proposing a fairly long period of time over which these reductions should take place. We are talking about basically within this decade. We are not talking about next year. And our obligation is to present a package of measures that, in our view, would bring an outcome for the US that would put the fiscal position of the US in a stronger place. Our justification is now is a good time. The US economy is very strong, and it is in good times where you can do more to prepare yourself for risks in the future. It is clear, not just in the US, elsewhere in Europe, in other countries, emerging, developing economies, that taking action to create fiscal space for the future is difficult, politically difficult to bring the public on board. Our view is that the more thinking that goes into bringing people on board, recognizing that ultimately it is for the benefit of the economy, the benefit of businesses and households that this is done. The more of that, if you wish, education of people and bringing them on that notion that a strong fiscal position in a world where we experience more frequent and severe shocks is really a good thing. And our part is to present justification for it as we see it coming from evidence, from the data.
Okay. Let's go David Lauder.
Hi, thanks, Managing Director David Lauder with Reuters in Washington. Just to follow up on the advice, the fiscal advice that you have for the U.S., I'm just wondering, how concerned are you that the next administration will take things the other way and spend more and increase the debt further? Are you trying to send a message here that this is really a place you shouldn't be going? And then also, in terms of the consequences, you identify some rollover risk for U.S. debt. What are the consequences for the world economy if we get into a position where, the U.S. is really sort of having trouble, finding buyers for treasuries? Thank you.
What our role is to objectively assess the status of any economy, the US or any other economy, and then present a policy path that, in our view, would serve the economy and its people well. And that is what we have done with this report, as we have done it in any other country. We don't speculate about political developments in any country. We know that it is the voice of people that would determine any administration. Our duty, present the picture the way we see it, and as objectively as possible define what combination of measures can lead to a good outcome. So I think I can go back into, and actually the administration has made some suggestions in that regard, to measures that are related to raising more revenues. That has to be done. Measures that can be taken to improve the quality of spending and also reduce spending in some areas, and then leave it to the country to do what is considered best.
There is also a question on the rollover risk.
Oh, yes, I'm so sorry. So here we are in a country where, when you look at the debt servicing costs, they remain quite manageable. In a country where the economy is performing extremely well, where the good performance is driven by productivity. And when we look at these conditions, we actually think that fast forward, the US can carry this debt, and we see no signs of the interest in investing in the US economy to weaken. In fact, when you look at money on the move, before the pandemic, 18% of financing seeking return outside of national borders came to the United States. Now it is 33%. 33% of money on the move come to the US. Why is that so? Because of the strong performance of the economy. And when you compare the US to, for example, the Eurozone, what you see are three very significant differences. Number one, innovation-driven economy and productivity as a primary source of growth. Number two, energy security, energy independence and ability, especially when you think about data centers and AI, to secure the energy necessary for them. Number three, ability to tap into labor, both in terms of getting people back to work, getting more women to go to work, and being an attractive place for people from other countries to come to. So when you look at this context, our judgment is that the US debt is sustainable, remains sustainable, and at the same time we're saying, look, debt level have gone up, deficit has gone up. Yes, you can carry it, but if you can bring it down, you would have an even stronger path for the future.
Perhaps just one, we're far away from any rollover risk in the US, no? But at the same time, is something that you never want to test. So basically have space for carry on and make the economy even stronger. This is one of the challenges that we see for the medium run. That is, everybody understands that the fiscal needs some work. But it's not that we are even close to problems.
I mean, David, the issue is always, I remember my predecessor, Christine Lagarde, would say, when the sun is shining, fix the roof. But like ordinary people who fix the roof more often when it is leaking, there is a temptation for economists to postpone decisions related to debt and deficit for the future rather than take them when the sun is shining, when conditions are good. So what we are doing is to add that voice of reason. You are in a good place, take advantage of it. And then, you know the saying, you can take a horse to water, you cannot force the horse to drink.
So I'm going to take one question that's come in through the Press Center, and then we'll have time for one additional question, and I'll give that one to you, Eric. But first, let me read the question. It's from Mao Ling from Xinhua News Agency. Mao Ling asks, the U.S. Federal Reserve is delaying its rate cuts. What would be the impact on the U.S. economy, and what would be the impact on the global economy and emerging economies of this delayed rate cut?
Well, let me first clarify that we do not believe the Federal Reserve is delaying rate cuts. What the Fed is doing is to be cautious to go for rate cuts when conditions are right, when there is full confidence that there would be no reversal in inflation. And stress that this is important for the US, but it is also important for the rest of the world, because if inflation in the United States is not sustainably brought back to price stability, to levels that give confidence, that would be detrimental for the US, but it also risks, instead of seeing gradual rate cuts, to go for the opposite, to have the Fed to need to actually tighten. So that caution the Fed is exercising is justified. When we look into the prospects, from our perspective, we still see the potential for one rate cut within 2024. Of course, based only on confirming that desirability of this cut data, and then we see potentially further cuts in 2025. Very important for the rest of the world, because when interest rates are high, for those who finance themselves in dollars, that causes increase in debt servicing burden. And what we also know is that when the interest rates are high, the dollar is high. The flip side of it is many national currencies depreciate, making it harder for countries with depreciating currencies to fight inflation on their own ground.
Okay. Eric, last question is for you.
Yes, thank you, Managing Director. I wanted to ask you about this theme of fragmentation that we keep hearing from the fund, because we, certainly in the US election, we have the first presidential debate tonight. We've seen the current administration, which has quadrupled tariffs on the electric vehicles, added some new tariffs, electric vehicles from China, added new tariffs on semiconductors and some other areas, as well as an alternative in the main opposition candidate who is on the campaign promising 60% tariffs on China, 10% on the rest of the world. How worried are you that, as David asked on the debt and deficit side, that the trend in the U.S. Is only getting towards more protectionism, excuse me, more fragmentation, and just a greater presence of trade barriers in the opposite of the direction that the fund is recommending the U.S. pursue?
Well, let me start by stressing that the U.S. is a very open and highly competitive economy. Even with the measures that have been taken, it remains a place where trading with the rest of the world is very active. My second point is that to recognize that over the last years, there has been clear evidence of two things. One, the decades of globalization have led to overall positive outcomes, but negative consequences for some communities, including here in the United States, with jobs disappearing as a result of cheap imports from other countries. And we, all of us economists, we have been somewhat complacent to reflect on that unfairness of the impact of globalization, and a bit slow to see how that translates into a pushback on what is actually a very good thing for the world economy, for national economies, for people, especially for poor people, because it brings lower prices and it brings bigger access to goods and services. Not just in the United States. If you look at the outcome of elections in Europe, it indicates that this is a genuine concern of a very big part of populations, and it has to be taken seriously. And the second observation that we must make is that both the pandemic and the war in Ukraine, Russia's war in Ukraine, they have demonstrated the fragility of supply chains, and they have reinforced the message that supply chain security is an economic priority. It has to be taken seriously. When you put on top of it the increase in geopolitical tensions, especially since Russia's war, that have made national security a bigger preoccupation, even from an economic perspective, we end up with measures that countries are taking, not just the United States, that are taking to provide security of supply and also to look at ways in which their national interests are best protected. Now, at the fund, we recognize these trends. And at the same time, we are loud and clear on the need for dialogue and solving differences and moderating this impact of strengthening security of supplies, taking measures that have been in the United States and elsewhere now more popular. We would like to bring that voice of reason in the future. We would do it now, we do it in this report, we do it in our broader work, because we genuinely believe that there can be fair and inclusive rules-based international trading system that is mindful of these lessons from the last years. In other words, don't throw the baby with the bathwater.
And with those final words, I will thank all of you for joining us here today. We're bringing this press briefing to an end. The transcript will be available, as always, on imf.org. If you have any additional queries, please do not hesitate to reach out to media@imf.org. And thank you all for joining us today. We wish you a wonderful day.